Yo, what up everyone, and welcome back to this new stream here on the channel. And yes, on today's stream we're going to talk about the FOMC meeting. We're going to talk about the interest rate hike decision that will be happening and will be getting announced in 13 minutes from now on. I mean, it won't be a big surprise, and I can already tell you as well, since the market and since the consensus is right now that we're at the peak of the interest rate hike cycle, we're probably not going to see a lot of volatility today. So I mean, where the real volatility lies is really in that FOMC meeting from Jerome Powell. So I will be talking about this a little bit later. We have sound. Some people are saying I'm muted. I am not muted at all. It should be okay. Let me quickly check. Everyone's saying muted. Wow, is it really not working? Let me check. Let me quickly check, because everyone in the chat is saying this. Excuse me for this. In my opinion, it should be working just fine here. It is working. It is working. So, sorry. So we're going to talk about the FOMC meeting today. I'm going to give you guys some very good analysis about the Bitcoin price action right here. I prepared loads and loads of charts. So, yeah, guys, without any further ado, in exactly 12 minutes from now on, we're going to get the FOMC meeting interest rate hike decision. So let me first talk about that. I just got pranked. Indeed, I see it, guys. So let me first talk about what I think is going to be happening next year. So let me also put the chat here a little bit closer so I can read it a little bit more easy. So guys, make sure to drop things in the chat. I'm reading it straight away here as well. But first of all, looking about what currently is happening and what we could be expecting. I mean, we have really seen that the open interest in the market has once again been rising for Bitcoin. And this is actually, if it is going to be loading up right here, is actually a very interesting development. So let me quickly load it up again here. This is a very interesting development in the market. Yeah, it's here. So what we can currently see, what the big difference is here on Bitcoin, and one of the reasons why I'm actually quite excited about this move that we got here in the market, is that the chart here below is the open interest. And like we do know from historical times, once open interest is high, it usually brings some risk on trading on Bitcoin, because then there could be, of course, some big liquidations, and there could be people chasing for you for your liquidations. And once open interest is low, usually it's a good buying opportunity, and usually it means the market is in low risk stages. So right now we're actually sitting in periods of low open interest, and I mean, every single time we've been seeing these lows getting hit in the market. So that was right here. That is, of course, this region right here. That was this region right here, and also this region right here. This region right here, this region right here, and this region right here. So this is all the regions where basically the open interest was in the red box, and basically meant a pretty good buying opportunity in hindsight. So yeah, pretty excited about it. But what I'm expecting today here is probably that we're going to see a lot of volatility, and probably as well that we're going to see Bitcoin spike up and down very fastly as well. And that got something to do with the open interest that has actually been rising in this market. So a few more things I want to be discussing here before going in towards my Bitcoin price analysis here is to talk about what currently is really happening on this market, right? So let me go to this chart right here. So right now we're just a few minutes out here before the interest rate hike decision is going to take place. And look at this. These red lines right here are all representing the last times that we had this meeting. And I mean, the last time it happened, nothing really happened for Bitcoin. The time before that, actually, it sparked a big rally towards the upside, but basically is not really showing a lot of volatility what it used to do in the past, right? So why is this happening is because right now, the consensus is already a little bit more clear. We already know what is going to be happening, because yes, right now it will be no big surprise here, because for this meeting that we're going to be having in for the decision that's going to be happening in 9 minutes, there is a 99.0% chance that the interest rate is just going to get paused. But I don't think that it is important to know, or of course it's important to know, but I don't think it will be having a big effect on the market. However, what I do think is going to be having a big effect on the market is that FOMC meeting, because the FOMC meeting is the meeting where Jerome Powell is going to start talking. He maybe is going to say some very important things that we need to know about. And if he is going to say some very important things we need to know about, we're just, of course, going to cover it straight away here on the channel and also, of course, across my Twitter page. So currently, the general consensus is that we're just going to stick around the 525 to 550% interest rate hike, So when are we expecting that cut happening, right? So the very most likeliest scenario that we're going to see a cut is just in June 2024. And of course, if we learn from the history, interest rates, they get cut if something catastrophic happens in the market. And in high interest rates don't necessarily mean the market is going to dump. So you can see it in this chart right here. So here you see the green line. That is the period where the interest rate hikes were basically getting increased. And the red were basically ones they were getting decreased. And the interest rates always go lower once the market is experiencing a crash, because the Fed will only lower the interest rates once the system is breaking. So yes, I am really expecting that once the interest rates is getting lowered, that is also the point that the economy is getting broken. And basically at the point that the economy is really broken the most, and they're injecting the most amount of money, that is the point where the bottom is formed. And that is also the point what is basically equaling the best buying opportunity there's going to be in the market. So yes, I still think we're going to have a massive crash. I don't think it's going to be happening in the coming 3 months, maybe not even the coming 6 months, but potentially in the coming year, right? So that is what I'm looking out for. And I think for the coming months, Bitcoin is looking actually quite bullish. And let me talk about why I think Bitcoin is looking bullish. First of all, I mean, guys, we're currently 5 minutes out before the decision is going to get made. This is probably going to cause a little bit of volatility. I mean, I'm saying it's going to cause volatility, but to be very honest, what I really think, it's not going to cause any volatility at all because it's so priced in. I mean, you have to understand, there's a 99%, the market has already priced it in for 99.0%. So yeah, probably there's not going to really be a big move in the market right now. But once Jerome Powell is going to start talking, that is the point where we're really going to start to see that next move going to create it. But people are all asking me about what is going to be next for Bitcoin and where should we be looking out for? I mean, I've got a very clear answer where to be looking out for, because right now, Bitcoin is actually doing some very bullish consolidation. And to be very honest, I think that Bitcoin is looking actually quite strong here. So Bitcoin is creating a consolidation phase here after it rallied here towards the upside, towards approximately 27.4K. So let me first talk about this. So, I mean, I talked about this movement towards the downside on the channel numerous times. And I talked exactly about this buy range. I mean, if you were following the channel in this entire region right here, ever since we came down and ever since we had this wick here, I said to everyone out there, I am expecting Bitcoin is going to see a fake out towards the downside and then recover towards the upside. And that is exactly what happened, like I've been predicting. And ever since that happened, we've been moving towards the upside. And realistically speaking, I'm just looking at the most important resistance lines here in this trend. There are just two very important resistance lines above us. And that is, of course, 27.8K. And yes, above it is going to be 28.8K. So those are the two most important levels on the top side. The most important levels on the lower side is definitely 25.6K and $25,000 to 24.8K. So those are the support targets. Those are the resistance targets to be breaking. So looking at Bitcoin on the imminent short term, I mean, we've been really creeping towards the upside. We've been really creeping towards the opposite, and right now we're starting to create a new consolidation pattern. And people are spamming about BLZ. I'm going to talk about it as well here. I got it all prepared, but please don't spam in the chat, otherwise you are going to get blocked here. So please just wait. We've got a whole stream in front of us, and I can guarantee you guys, I can show you what I've got prepared. You can see it here on the top side. All these steps are all the things I'm going to discuss, and this is just my third tab. So just wait a little bit here, guys. I've got so many charts prepared for you guys out there on the channel, so make sure to stick with me. And in 4 minutes from now, we're also going to get the interest rate hike decision. And if you follow me on Twitter, you will be the first one to know where it is exactly going to come in at. So make sure to follow me over there as well. And guys, once the news comes out, I will tell you guys straight away here, because I'm following the news live here on my other screen. So Looking at Bitcoin, we're creating a consolidation phase here with the price target here on the top side of 27.8k. So I'm going to look closely towards a potential breakout of this pattern. What is going to be breaking upwards or downwards, that is of course going to tell us the direction where we're heading towards. I won't be surprised to see a small little fake out here, since yes, guys, the FOMC meeting is always causing massive market shakeouts. It always causes these moves, so make sure to be prepared for that here. Quickly talk about Bitcoin on the daily time frame. We actually broke the downward sloping resist line, and I mean, this move that we're currently creating is so similar to compared to the previous move we created. I mean, on the previous move, the fractal, we had that downward sloping resist line, that horizontal support line, we broke below it. Here's well, horizontal support line, we broke below it. And look at this candle right here. Guys, look at this candle right here. I think I've got a chart. Yeah, this chart right here. I talked about this the moment we created this candle. Guys, I know my stuff. This is a bullish engulfing candle. And a bullish engulfing candle basically is indicating a trend reversal. And I mean, so far we've seen the trend reversal definitely getting created. But you have to understand, Bitcoin is right now still trading in a daily downtrend. Because yes, we're still creating lower highs on the daily time frame. What means that we're technically speaking still in a bearish trend. But since we created that bullish engulfing candle and we broke above the downward sloping resist line on the daily time frame, potentially today could be the day that we're going to mark that reversal and that we're going to be marking the beginning of the next move here towards the upside. And people are saying, are you going to trade live here? Guys, yes, of course. If I see an opportunity today, I am going to take it. I've been looking to some opportunities. I've already accumulated some trades here in the past 2 weeks here, actually. I've been accumulating a swing trade on Ethereum because I see so many people are super bearish on Ethereum, but I'm going to talk about this all later on the stream, guys. So make sure to stick in the stream right now here. That will be definitely very important to be doing. So Bitcoin created that bullish engulfing candle, and after that, we've seen the upside getting created. But that is why it is so important to be watching towards these patterns that were created in the market. I mean, these candlestick patterns. So a bullish engulfing candle got created, and ever since after that, Bitcoin moved towards the upside, what is of course a very good development in my opinion. But yes, if we really want to be seeing a big trend reversal, also if you're going to be looking at the super trend indicator, you can clearly see right now the trend is still bearish actually, and we really need to be breaking above that previous resistance high. And if we do that, then we can definitely manage to be looking for higher highs. So guys, let me quickly cover the news. Because in a few seconds, to be exact, 20 seconds, we're going to get the interest rate hike decision. So I'm going to quickly go to the lower time frame, guys, because look at this. This is what volatility is. I mean, this is not a very big volatility that will probably happen right now here. This is the 1 minute time frame. I'm checking up the news, guys, about what it is going to be here. Maybe the Federal Reserve is going to be surprising us with something. But Bitcoin is moving up right now here, and that's, of course, lovely to see here. So looking at what currently is happening. And it is no interest rate hike at all. So they decided to not increase the interest rates. That's a good thing here. The Fed decided to not increase the US interest rates. Okay, so yeah, of course, this is nothing real new, like I talked about, because the probabilities were already 99% here. So yeah, that's pretty okay here. Bitcoin is indeed reacting towards it. So we are already starting to see some volatility hit the market right now. And let me quickly check up on some other numerous sources, what they are saying. So yeah, it's exactly like we've been predicting. The Fed decided to not increase the US interest rates. So yeah, I am not really expecting a lot of volatility. I mean, yeah, Bitcoin is right now moving. Be aware, this is the 1 minute time frame. So putting this on the 15, this is not really a big move that we're currently creating. And personally, I don't really think there is necessarily going to be a super big move here. Also, quickly checking up on the S&P 500. We can see, yeah, we are having a slight dip towards the downside, but not really a big move that we're currently creating because, yes, this news is not really unexpected. So let me continue with where I was talking about my analysis on Bitcoin before I'm going to go further in towards what is happening on Bitcoin. So let me quickly check. On my other screen, I will be closely monitor the Bitcoin price action. If something crazy happens, guys, you are on the right stream because I'm the first one to be reacting towards it. So quickly continuing with my analysis, guys, in 30 minutes from now on, Jerome Powell is going to start talking. So make sure to stay in the stream because I will be live streaming this as well. And at the same time do TA, and at the same time potentially, if I see trading opportunities, do some crazy trades here on the channel. So make sure to continue watching for that here. I mean, on the 3-day time frame for Bitcoin, things are looking actually quite exciting. We're creating that lower low on the RSI, higher low on the price action on Bitcoin. We're creating a hidden bullish divergence on the 3-day time frame. And if you're looking closer to any other time frame, guys, here, I mean, we've been clearly seeing this reversal getting printed on our eyes many times before. We create that lower low on the price action. On the RSI, we create that higher low. So also bullish divergence on the daily time frame. We printed this as well on the 12-hour time frame. We printed this on so many different time frames that it is actually quite obvious that we're right now having this move towards the upside. But still, yes, guys, be on high alert. We may be bouncing towards the upside right now, and I've been talking about this several times before as well. But in order to be flipping bullish, I really want to be seeing the 27.8K getting broken. Until that, I believe that we're in a bearish trend since we're creating lower highs. And if we do break above this previous high right here, then I will be expecting a reversal for Bitcoin. And maybe one of the most interesting things that currently is playing out here is that the previous bull market, so the previous phase above the $32,000 or the $30,000, I could better say, exactly lasted for 494 days. And the period for Bitcoin to be trading below that $30,000 barrier is currently exactly lasting for 494 days. So the period is exactly the same. That's quite exciting, isn't it? Quite exciting, isn't it? I've been saying this as well to my viewers many times before. If Bitcoin breaks above $32,000, that is this red box right here in the middle, that is the point where really the market is going to change. That is the point where really, I would say, the bear market is right now. Of course, I think already the bear market is behind us because, yeah, $16,000 is really depressing. But at that point, it would definitely change up the entire environment, and it will probably also really generate a different narrative in the market. So continuing with the analysis, I mean, on the weekly time frame, actually like this pattern that we're currently creating, this cup and handle pattern, is super bullish. I mean, if you're looking at the weekly structure of this, it is looking so bullish. And I mean, I'm not just purely talking about the structure right here, but I can go to some different charts as well here. I mean, this is not, oh yeah, this is the right chart, sorry. So I mean, I'm not only talking about this structure right here that we're creating, but look at this upward sloping support line that we're currently creating here on the weekly time frame. This is massive. We exactly bounced from it on the previous bear market. We exactly bounced from it in the 2018-19 bear market. I mean, if this is the trend that's going to continue for Bitcoin, I mean, the bear market bottom of 2026 is going to be sitting somewhere around $60,000. And I mean, I wouldn't really be surprised if that is really going to be happening. But I mean, the weekly structure that we're currently creating is so bullish. If we are right now already bouncing back towards the upside, we could be starting to see a massive W get created, and that will be epic for the weekly time frame. And I mean, if we really approach that $32,000 right now here, the setup that we're creating is ultimately going to be looking super bullish. And yeah, we definitely have got a lot of stuff to talk about if that really is going to be happening. So let me quickly take a sip of water. And let me look at the chat. DXY, what the fuck? Okay, let me quickly check up on the DXY. DXY had actually seen, wow, crazy. Actually, the DXY has been very strong lately. It has really been bouncing back towards the upside. Let me go to the 3-day time frame to quickly show you this, guys. So, like we know, the dollar index is super important because, yeah, the dollar is invertedly correlated against Bitcoin. But yeah, wow, we had a very strong period for the dollar, but I think the strong period for the dollar is of course going to end once the interest rates come lower or other countries are going to have higher interest rates. But for now, the US is the one with the highest interest rates, so that's why the dollar remains to be very strong. So that's interesting to be seeing. We are currently knocking on pretty interesting resistance. And of course, for us, for the Bitcoin maxis or just cryptocurrency maxis, we would like to see the dollar index go down because, yeah, the dollar is calculated against Bitcoin. So, yeah, if the dollar goes down, the Bitcoin value goes up. I think ultimately we could be breaking higher purely due to the fact of the fundamentals of the dollar index right now here due to the high interest rates. So also in just a moment from now on, once Jerome Powell is going to start talking, it could really influence the dollar index. So we're going to watch that closely. I mean, in the meantime, if we're watching Bitcoin closely, let me go back to the Bitcoin price action, guys. Meanwhile, once we're watching Bitcoin closely, we can also see that, I mean, we're already recovering that small push towards the downside that we had in the market. So, I mean, weekly time frame looking pretty interesting in my opinion. And also a very interesting thing, in my opinion, is actually the weekly volume that has been still declining. And I mean, we can really see it across the market. The volume has been declining. We can see it across exchanges. I mean, I looked towards volume quite closely because volume is a very good metric to see where the market is standing. I mean, of course, I can already see the sentiment is down due to the fact the views are lower, not only on my channel, but all channels, also on Twitter. You can clearly measure it on that way as well. And I mean, it's quite funny that the bear market is exactly repeating and it's almost no one is paying attention towards this market. So things are exactly playing out like it should be playing out, and I mean it's completely no different than the previous bear market. So that makes myself super excited about it, but the volume remains to be dropping. It's not that bad, of course, that the volume is dropping so significantly, but clearly we can see that across exchanges volume has been declining. And I mean, an important thing to be looking at, and I've been saying this for a while right now here, I think the Bitcoin dominance is going to remain to be strong here, and it's not purely because I'm a Bitcoin maxim, no, but purely due to the fact of the news and all the stuff that currently is going on here. I mean, of course, everyone is talking about a Bitcoin spot ETF, and guys, I got a completely different view on a Bitcoin spot ETF. I went to Token 2049 in Singapore, and I talked with so many people about the spot ETF. And it's actually quite funny that like almost everyone is saying like, oh, once a spot ETF is going to hit the market, is going to change Bitcoin for good instantly. But I don't think so. I think once the Bitcoin spot ETF is going to come out, it's not necessarily going to give a big upside immediately for Bitcoin. However, for the long run, it's definitely going to change things here. But what I really think is going to be happening, because now I've got to explain since I'm talking about it, and I think it's very important to notice, is that a spot ETF is really going to give the opportunities for institutions to be buying in towards Bitcoin once the market and the narrative is positive for Bitcoin. And I mean, BlackRock, are they really buying Bitcoin right now here? I mean, I'm doubting, because BlackRock, they make money from management fee. So why should they be buying right now here? Makes no sense, right? So yeah, they don't really care about where their clients buy. Of course, they care about the performance. But the spot ETF is only going to be in gateway. And look at this. This was the point the gold ETF got introduced. It really generated a massive uptick in the price of gold as well. So yeah, there's a lot of money to be making here, and do be on high alert. In approximately 3 to 4 weeks right now here, it's about 3 to 4 weeks. Yeah, we're going to get the next deadline for the next Bitcoin spot ETF. So that is actually quite exciting. And the next Bitcoin spot ETF is, the next deadline for the Bitcoin spot ETF is probably going to get declined again here. And where it really is going to be mattering is the third deadline and potentially the final deadline. So the expectation as well here, Q1 2024 is where probably the Bitcoin spot ETF is going to get approved. So yeah, looking forward towards it. But personally, I think once it gets approved, they all get approved at the same time, because otherwise it wouldn't be fair. On the 2-hour chart, touching the 21 EMA, making an L there. Let me quickly check up here on the 2-hour. I mean, what I really think about, I've been talking about this with some other people this morning already, but I really like the price action Bitcoin is creating right now here. And why I'm saying this is because Bitcoin is slowly creeping up towards the upside. Slowly. I really like the price action right here. I mean, I'm not looking at the 21 EMA. I think it's not necessarily, this is not my strategy of trading, but I like to be looking at the candlesticks and the strength in the market. So quickly talking about the BLZ. And talking about some trading opportunities. I think BLZ, what I've been doing lately, since I've been a little bit bored, and since my Twitter got hacked, I traded TRB as well. I traded some coins that were massively overpumped, but TRB as well, because you could got like 1000 APR on Binance. I shorted. You can literally see it right here. You can still see my orders even. So I shorted it here, bought it here, so made some very decent profit with it actually. TRB was definitely a good trade for me. Looking to potentially trade it again here actually. I've been shorting this one, and I closed my positions unfortunately around $38. Volt went even lower to 24, so that was a little bit sad here. But there are a lot of these coins that are pumping like crazy, and one of them is BLZ. And actually BLZ is right now running it towards my resistance target, and you can currently clearly see here, this was the previous high in the market, boom. This was previous support, and right now it's running in towards its resistance. And what I don't like, and the reason why I'm shorting this coin, is because this coin, look at their website traffic. Look at everything what they're doing. Either this is one, manipulation, what it is already probably. So it's not sustainable, this high price. And second of all, the project has always got no users. So I personally think it's pumped up, it's overhyped, and I think it's going to crash very quickly. Like it has been doing in the past as well. So I've been trading this. I've been actually opened my short position on 20.4, and my stop loss is on 23 cents. And I've announced this as well on my Twitter. I think that BLZ is not really a good buy right now here, and I personally think it's going to come down. And what is very interesting on the market right now here, because guys, in 15 minutes, make sure to stick in the stream, because in 15 minutes, we're going to watch Jerome Powell start to talk on the market, and we're going to discuss it live here on the channel. But what is interesting right now here is that funding rates are negative across the entire market and also across altcoins. And for the ones that don't know what it means here, is that CFDs, if you trade them, you've got a long and short side. And the long traders, they pay the shorts, and the short traders pay the longs. And since everyone is shorting Bitcoin right now here, you have to pay a premium to short. And that is what basically what it means if there's a negative funding rate. So Bitcoin and Ethereum all got negative funding rate, and that makes me actually quite excited about this market right now here. One thing I want to be saying here to everyone out there on the channel, I don't know who is actually like trading still on Binance. Binance volume has been massively down here, but I personally have my doubts on trusting Binance. I used to work together with them, and I actually stopped working together with them because I've got my doubts and they're not giving me answers. And I ask around here because I've been around in crypto. I know some guys at Binance as well and multiple exchanges. And I asked them as well, guys at Binance, can you explain this report to me? Because Binance released their 10th reserve audit report. And in their reserve audit report, where basically they say how much Bitcoin they hold and Ethereum or USDT for their customer reserves. Because yes, we know how FTX collapsed because they didn't have enough customer reserves. And that is why we got the audit report. And Binance is doing an audit report, and you can see it on the top left side of the screen with self-verification. And I really got scared of this. I got really scared of this because why aren't they using a third party to do this? Because if you use a third party, I can trust it. But if it's self-verification, I have got no clue at all what was going on here. And then as well, Binance may be on number one with their trust score on CoinMarketCap, but be on high alert. Do you know who owns CoinMarketCap? It is Binance. So it's from the same company. So and also the audit reports are shared on CoinMarketCap, but also is owned by Binance. So I am a little bit scared here also about the volume and about what is exactly happening there, reported by CoinMarketCap. So, I mean, yeah, for the ones that are really interested in trading, I'm personally stepping away from Binance, and I can show you guys even, but I'm holding $0 on Binance right now here. I completely cleaned my account. I actually closed my account as well. So yeah, not really. Wow, just some very big spam. Guys, if you're spamming, you're going to just get mute for a lifetime. So you're going to get one timeout, and after that, you're going to get a mute for a lifetime. So please don't spam here because I'm not going to reply to that. But yeah, I mean, if you want to be trading, also Binance, they closed their corporation or the thing that they're doing with MasterCard. And right now, with Visa. And now BYBIT, you can see it on the bottom left side on the face cam. BYBIT got his own card. This is the BYBIT card. And with this card, you can literally spend your crypto. So yeah, that's exactly what I'm doing as well. I'm spending my crypto using the BYBIT card. So that's absolutely epic. So if you want to be trading, check it out on BYBIT. BYBIT is also the fastest growing exchange out there in the market right now here. And if you go to the link description, you can actually claim a free $1,000 for only depositing $100. And you can literally read what you have to do right here, the conditions to claim. You, of course, have to sign up with the link. You need to deposit $100 within 7 days. And you have to complete KYC. And then you can literally claim a free $1,000 US. So it's that simple, no hooks. And it's super easy. It's super easy. So only deposit $100. That's literally the only condition within 7 days, and you can claim a free $1,000 US. So go to the link description if you want to claim it. You can also use the BYBIT card to spend your crypto. And guys, let me quickly show you this. Quickly going to my second screen here, because this is quite epic. So let me show you this, guys. I have to be very careful if I'm not showing anything. Boom. So this is a thing I can show. So I have to be very careful if I don't share my my contact details, because then maybe I'm going to get hacked. But literally what you can do, you can spend with the BYBIT card and earn 6% APR. So that's literally what I'm doing. I just enabled it, so you can clearly see I've got 0 yields yet. But before the video, I found out about it because, yeah, I got a chat with someone from BYBIT. And that's crazy. So you can use your BYBIT card to spend crypto and at the same time earn 6% yield a year. So that's crazy on your USDT. So yeah, just want to be saying that. And of course, I think BYBIT definitely got a very good order book. So check it out in the link description. Further on, I mean, we're right now 12 minutes out before the FOMC meeting starts. So let me, some people are asking me for TRB analysis. So TRB is definitely very interesting in my opinion. So I'm also trading TRB on BYBIT. TRB is right now actually running in towards my resistance, because you can clearly see this is the order block. I think we've got some more room towards the upside. I mean, TRB is super volatile. You can clearly see it. I mean, I've been trading it myself as well. I have been trading TRB myself as well. Like I just, oh, it's still here on the screen. I was literally trading it as well in the 1 second with that Martini guy once I was in Singapore. So that is how I also found out of it. But TRB, in my opinion, still got some room towards the upside, and probably it will still go towards the upside. And really, the level where I want to be shorting this is at this level right here. Once we're hitting these highs, I don't think it's going to create a new high. I mean, the chart doesn't look like it. It really looks like topping out right now here. So I should be very careful with it. I should be very careful with it. But I think like 41.5 to 41.8 is a very good level to be entering your positions. That looks for me to be a very good place to be entering. But why are you do you save your crypto on BYBIT? Personally, I've got like, I can show you. I think I've got like 85K right now on my BYBIT accounts. Where do I really store my crypto? So the money that I use for trading, I store on BYBIT. Sometimes I used to do my spot savings as well on BYBIT. I think I personally trust BYBIT, but you know, if Binance goes bust, you never know what happens, you know? So where do you really want to be holding your stable coins? I'm not going to hold my stable reserves on an exchange. So my stable reserves, I just hold, I'm not going to say where exactly because, yeah, for my own safety, but not on an exchange, just for that. So yeah, I don't hold all my money, of course, on an exchange. That will be just stupid. But usually my maximum that I hold on an exchange is $200,000. But of course, maybe your financial situation will be a little bit different. So yeah, it really depends on the person. But for me, it's maximum $200,000. And maybe the bull run is going to be more because maybe I've got way more money to spend as well. So it really depends on the market period. But for now on, it's like my maximum is $200,000 that I want to hold on an exchange. I hold it also on multiple exchanges, some stuff. I don't think exchanges are bad. But of course, I want to have Bitcoin in my own custody. TRB, I think TRB is really eventually going to collapse like massively. But this move down here, it's epic, guys. It was like a 40% move in just a few hours. So there's so much money to make here right now. Well, Bitcoin has been so boring, actually. these altcoins have been really the place to be if you want to really trade the market. So if you are interested in trading, I think altcoins are the better way to go right now here. And yeah, just like I said, if you want to be trading, go to the link description. Like, this deposit bonus is super, super rare. Like a free $1,000. You can go to the link description to find it. And you only need to deposit $100. So it's absolutely insane. And let me see what the chat is saying. Arbitrum analysis. Guys, I know some stuff going on with Arbitrum. Because I know market makers, guys. I've got way smarter in the past period. I learned so many. Yeah, I got to know so many more new people about what happened with Arbitrum. So, guys, do you want to know an interesting story? What I know, and I think you can find it if you dive deep in towards it on the internet. But what happened with Arbitrum is that how it works. If you launch a coin, you're going to need a market maker. A market maker is basically someone that stabilizes the price. They sell and buy, and they get a certain amount of tokens and a certain amount of dollars to create price stability. And they had a goal to sell an X amount of money in the market to market make. And the rest of the tokens, so if the price goes way higher, they basically earn the tokens, so that they basically get free money, the market maker. And the market maker from Arbitrum made so much money that he sold all the requirements super quickly. And now he's still got an approximately, what was it, like 150 mil, sorry, it was more. It was like 3% of the supply, 4% of the supply, what is actually like quite a lot. You don't think it doesn't sound like a lot, but it is a lot that he still can sell off here because he made so much money on the launch with Arbitrum, and the launch was so successful in Arbitrum. So there could be still some price suppression due to that knowledge. But purely looking at the chart, let me do some diving deep in the chart. I think Arbitrum is going to do well in the next bull run, but still, I think we can go lower. I still think we can go lower, and it's very hard to spot where the support is going to be since it's just only going down, right? But yeah, I personally think it is going to go lower. Very sad reality. I mean, what you really want to be looking at is the downward sloping resistance, right? So, I mean, yeah, you can clearly see we're still trading in a downtrend. We're creating this downtrend right here. But, I mean, for the daily time frame, where you should be maybe willing to look at is this trend right here. So maybe if as soon as we do break this trend right here, that could mark a very big difference in the price action of Arbitrum. Maybe it's then already a little bit too late to be buying it, since then it's already up 20%. But I think the risk on buying Arbitrum right now is still pretty high in the market due to the things that I know in the market as well right now. So please, what is Powell saying? Powell will be starting to talk in 6 minutes, guys. And don't be afraid, because like you can see, boom, I've already got it ready, guys. Once the meeting starts for Powell, we will be watching it both together on this stream here on the channel. I've got my Bitcoin on the ledger. Is that safe? I mean, depends where your ledger is, of course, but I'm using Ledger myself as well. I'm using multiple self-custody services, but I think Ledger is definitely safe, depending if you're storing your private keys and your seed phrase on the internet, or you're just storing them in physical places. So really depends on how you're saving it. TRB is going to $52. I think it's a Ponzi. I don't think so. That is going to be happening. So we're 5 minutes out, guys, before the FOMC meeting starts. Make sure to share this video if you're interested in the FOMC meeting, but definitely the market is less excited about it. I mean, XRP has been bouncing towards the upside. I still think XRP is one of the top holds for the next bull run. You can clearly see also that we're creating this massive pattern right here. We're creating this massive consolidation phase, and then we're just waiting for that massive breakout. What do you think about the Bitcoin weekly and daily depth cross? I mean, the weekly depth cross already happened a while ago. Boom. Let me fix this. So let me start with the weekly depth cross. So the weekly depth cross already happened a while, and I have to go to the right chart. Sorry. Yeah, this is also not the right chart, guys. I need to find a clear chart. Yeah, this one. So the weekly depth cross already happened a while ago. That happened here in February 2023. It was the first time ever we had a weekly depth cross, and the daily depth cross it just happened recently. But we're right now actually knocking on the 200 daily moving average. What is actually quite interesting to be seeing. We're about to be breaking above it as well here. And this is historically speaking massive resistance. You can also clearly see it right here. Boom. And once you break above it, you tend to see a very fast move. Here also a few rejections. Here also, you see clearly how important the 200 daily moving average is. The point you break above the 200 daily, you see these big moves towards the upside. Here also massive rejection. So yeah, important to be paying attention towards this. But talking about the def cross itself, the def cross itself is not that big of a deal in my opinion. So here you saw also the def cross, and basically the def cross right here marked the buy zone. I mean, it marked the buy zone. And the bull cross right here marked the sell zone. And then in the previous bear market, we also saw a couple def crosses, a couple golden crosses. I mean, here the def cross indeed marked again on the imminent short term a buy signal, but eventually went down. Then here as well, we got another def cross, and that exactly happens. Exactly once that happened, we pumped towards the upside. And then we had a golden cross. And then, here we had a def cross, and exactly the def cross came, and it marked a very good buying opportunity. So, I mean, def crosses, they historically speaking indicate a good buying opportunity. So, I don't know why we call it a def cross still, because, yeah, it's marking actually a very good buying opportunity. So, yeah, I've discussed this already a while ago since, it happened a while ago as well. But important to pay attention. Very important to pay attention. Rover, where is Paul? I've got no clue who Paul is, so tell me. Ethereum will outperform Bitcoin. I think so as well. I mean, if you just personally, I am scrolling through Twitter, and Twitter is packed with negativity about Ethereum. And I mean, yes, indeed. Ethereum is breaking bearish against Bitcoin. But personally, I think that this is really marking the bottom due to the fact how many people are so bearish on Ethereum right now. And I mean, don't take me all too serious on that here. Don't quote me on that. But I mean, here you can see, this is in my opinion a very important level to be watching. I think this is a super important level to be watching. This 53 to 54 level. I think that is going to be a very good buying opportunity for Bitcoin against Ethereum. Bitcoin has been losing, of course, a lot of value against Ethereum has been losing a lot of value against Bitcoin. But look at the pattern that we're currently creating. We are creating literally, let me draw this correctly. We are creating literally a falling wedge pattern. We're creating a falling wedge here on Ethereum against Bitcoin. And we're right now actually sitting on some support. So I won't be surprised that Ethereum is actually going to be bouncing from off this level and potentially heads a little bit higher. I think Ethereum, the point that so many people are talking so negatively about Ethereum, it is actually marking the bottom. So, guys, I need to open up to the FOMC meeting. I'm going to enable the sound. Oh, look at this. We're starting. So let me go to the Bitcoin price section as well. We're starting with the FOMC meeting. Jerome Powell is going to start talking, and it's going to have a massive influence on the price. So, guys, make sure to watch closely about what he's going to be saying here. I'm going to increase the volume as well. So, yeah, let's say I will talk about Bitcoin in the meantime. Of course, you can check Bitcoin in the background as well. We'll put up a nice chart so we can look closely to Bitcoin, what it is exactly doing. Because, yeah, Bitcoin usually reacts towards the things Jerome is saying. And sometimes he talks about Bitcoin. Oh, there he comes. Jerome Powell.
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely.
3% in 2026.
Sorry, the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keep
Very laggy stream.
keeping longer-term inflation expectations well anchored. It's essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and you know, we're seeing progress, and we welcome that. But you know, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, interest rates, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that, people just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Thanks. Let's go to Steve.
Steve Leishman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't you know, the model and that the economy reacts, and again, that's another reason why we're moving carefully now, because, you know, there are lags here. So it may of course be that the neutral rate has risen. You do see people, you don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters, thank you. So you've said several times that the economy needed a period of below trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit, 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say, though, I still think, and I think broadly people still think, that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, you know, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and you know, I also think. You know, this is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. the fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, you know, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, you know. And so what are we seeing? We're seeing, you know, through a combination of the, you know, the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, you know, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think what, you know, as we've said, we want to reach that, we want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, you know, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage
this year. And even then, it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. You know, is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, you know, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, you know, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, you know, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth that we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria. Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's the government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. To start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect, over time, a sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime-age labor force participation moving up, where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Let's go to Chris. Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5. What would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last 3 readings are very, very good readings. It's only 3 readings. We were well aware that we need to see more than 3 readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the 3 buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, it becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So,
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully, but at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move now, they would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, you know, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so they're not going to. It's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly were suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Okay, well, that was it. That was the FOMC meeting. I mean, to be very honest, let me quickly fix this. Am I here? One second. Okay, so guys, that was it for the FOMC meeting. To be very honest, Bitcoin really didn't really move that all here. Was it all too surprising? No, not at all. What's actually very surprising to see is that apparently they are expecting that the rates are going to stay low till this is so weird. So they're expecting the rates are going to stay around the 5% for the coming 2 years. That is literally what they said in the meeting. Personally, I don't really expect that is really going to be happening, since the Fed has got a history of lying. But anyways, the market not really moved a lot here. To be very honest, this was really expected, since, there's definitely less and less interest in the Fed meetings, since, the market is already exactly expecting about what is going to be happening. And literally the last 10 meetings have been like this. He's been saying the exact same things here. So no big surprises in this meeting again here. And that wraps it all up together. So guys, we'll be ending the stream right now here. Bitcoin is moving down here. It is actually potentially breaking down of this pattern. If we really break the support, we could be going a little bit lower here, but be on high alert. I think the overall trend here has been recovering slowly towards the upside. So I don't really think the macro is still shifting. I think the support that I want to be seeing to hold for Bitcoin is definitely 26.6K. So a break below 26.6K will be definitely catastrophic. but as long as that is not happening, it will be all okay. But anyways, this was it for me in today's update video. Live stream, I mean, it's not really a video. So guys, thank you so much for watching. I'm going to watch Bitcoin closely. If we can remain to be holding in this exact pattern, it will be quite bullish. Otherwise, my target is going to be 26.7K. And as long as we hold that, I think it is going to be okay. But anyways, guys, thank you so much for watching, and I'll see you guys on the next one.